Here are 6 easy tips to immediately make you better prepared for retirement. And the best part is that you can start doing all of these today. While they may seem pretty straightforward, these small changes often come up with clients and can be the difference between simply retiring and enjoying a stress-free retirement. The first tip is to get access to your online CRA account. If you don't already have this, then this should be your first step. We use the information on this website all the time with clients as it helps us track their taxable income and make informed decisions when it comes to their retirement cash flow plans. So why is this important and what sort of information are we looking for? Well, through the website, you'll be able to see how much room you have available in your tax-free savings account, so you can top that up if you aren't already maxed out. You can see how much room you still have remaining in your RSP to see whether or not it makes sense to do a final contribution while you're still working. And it's also going to tell us if you have any carry forward capital losses that we can apply to any future capital gains that you might incur. By staying on top of these numbers, we can avoid any tax surprises and make sure that our plan is tax efficient moving forward. So our second tip is to log into your My Service Canada account to find out what you're on track to receive from the CPP. Now, the CPP is probably going to make up a significant portion of your retirement income, and what you receive depends on a few factors like your earnings history, how many years you've contributed, and at what age you start receiving the pension. By logging into your My Service Canada account, you'll be able to see what you're on track to receive so that you can make an educated decision when it comes to either starting your CPP at 60, 65, or 70 years old. Again, at our firm, this is one of the most important numbers that we use when building out retirement plans. Rather than guessing, we'd rather use your actual projections to make an informed decision as to when you should start your CPP. Our third tip is to consolidate your accounts. Now, over time, you might accumulate multiple RSPs, tax-free savings accounts, pensions, investment accounts. And while this might seem harmless, when it comes to retirement planning, it can make things overly complicated. By having accounts all over the place, it makes things a lot more difficult and less efficient from a planning perspective. Again, let's just think about it. Let's say you have RSPs at 3 different financial institutions. There might be 3 different investment strategies, 3 different sets of slips whenever you're taking money out, 3 different sets of statements. It becomes overly complicated and not efficient when it comes to planning. You can also end up paying way more fees because you have your money spread out across different financial institutions. Now, selfishly, as an advisor for my clients, it makes things a lot easier when we're managing all the accounts because we know what's happening in all of them. And there's no surprise tax slips coming from accounts we don't know about, which can throw off our retirement and tax plan. Our fourth tip is to review your spending without having to actually stick to a strict budget. Now, let's be honest, nobody likes to budget, but before you do retire, it's good to have an idea of how much you're actually going to be spending. Instead of creating a strict budget, try this. Just track your expenses for a few months and see what expenses are still going to be necessary in retirement and what is going to be more on a discretionary basis. Once you have these figures, you can project them into retirement and get rid or add any other expenses that you might have once you're retired. So maybe more towards traveling or healthcare and less towards traveling to work every day. This simple exercise will help you determine how much income you actually need in retirement, and that will in turn give you a better idea whether or not you have enough savings to last you throughout retirement. Our fifth tip is to restructure your portfolio for retirement. Now, it's one thing to save for retirement, but when it comes to taking money out, it's a completely different ballgame, and therefore your portfolio should be set up differently than when it was when you were accumulating assets. But here's an easy strategy that you can use. Call it the 3 buckets. The first bucket is for the money that you're going to need over the next 2 years of your retirement. So because you need this money relatively soon, you put that in something extremely safe that's not going to be volatile. The second bucket is going to be your midterm money. So money that you need, let's say in years 3 to 8 of retirement. Again, you need this money relatively soon, so it should be invested in something conservatively that's not going to be too volatile. And then we have your third bucket that in this scenario, we're not going to touch for 8+ years. And because we don't need this money right away, it can be invested more aggressively. This approach protects you from bad market timing and ensures that you always have liquidity while still growing your portfolio. The sixth tip is to understand the different types of income on your tax return. A lot of retirees don't know this, and it can have a major impact on their tax and withdrawal strategy. On your tax return, you're going to see different types of income. So the first one is your total income. So this is what you've earned before any deductions. So the money that you received from your pension, RIF withdrawals, CPP, or let's say old age security. And then we have your net income. So this is your income after any deductions like RSP contributions or pension splitting. And then finally, we have your taxable income, which is the income that's going to actually be taxed after factoring in any deductions and tax credits. So why does this matter? Well, because different types of income will be taxed differently. So income from your CPP, OAS, RSP withdrawals, or RIF withdrawals are all going to be fully taxable. But if you have a non-registered account, then interest, dividends, and capital gains will all be treated differently. And then lastly, if you're withdrawing funds from a tax-free savings account, there won't be any tax implications at all. Knowing where your income falls within your provincial and federal tax brackets can help you avoid the old age security clawback or needlessly jumping into the next tax bracket and paying more taxes. Preparing for retirement doesn't have to be overwhelming, and using these 6 tips can get you on the right path. For all of your retirement needs, check us out at transcanadawealth.com.